Hello and welcome everyone to our third Wyckoff class. Now, I hope you guys haven't had, too much time to Wyckoff alone because I prefer you Wyking off with me. And I hope you guys are getting more confident in your Wyckoff skills with this course. Okay, so without any more delay, let's dive right into our book. Now, what we're talking about today is the law of cause and effect, which is the second law of the three laws that Wyckoff, postulates as the main drivers of a market. Now, what this law of cause and effect means is that for every single price movement, there is a cause. So no move in price happens without a reason. Now, in a more micro scale, when you're looking at like second charts, minute charts, that is probably, that cause is probably the individual transactions of individual sellers and individual buyers. Okay, so if the price goes up, it represents the desire of someone specifically to buy, probably, and if it goes down, it represents the desire of someone wanting to sell and getting that money. But over a long enough time frame, what we can say is that every single trend in price has a big cause and a narrative that is built to change, the stock, the asset, from the long-term holders and the large holders to the short-term holders and the, small holders. Okay, so this is the main argument that Wyckoff postulates. All right. Now, of course, it's not worth it to, try to analyze individual transactions, even because if you were to make any meaningful like decisions from that, you would need like an algorithmic trading strategy with little like small microsecond delays, and basically no one, has that capacity. Okay, don't try to think that you'll be the next trader that will profit from the 1 minute chart. You will not. All right. All right. So the main idea from Wyckoff is, as we discussed before, accumulations and distributions. And that usually happens when price goes sideways, okay? Like here, for example, or here, for example. And then during these periods, there is a cause being built for an asset to go up. There's a cause being built that this is the asset of the future or whatever, or if they want to generate some downward pressure, they start saying that it's going to go down and it's going to go to zero, and then it goes up, especially when they say that. Okay. So another very important thing about the law of cause and effect is that the effect of that cause is very, very proportional to the like the time that is spent building that cause. Okay, so let's see some examples here in the chart. So we can see a big accumulation period here. You can consider this basically an accumulation period. All right, and this lasted for months and months. So here specifically, let me grab the time measurement tool. This was basically a 462-day accumulation period. And then we saw a big explosive trend, right? We saw a huge explosive trend here. We can also look at this accumulation period here. Okay, this lasted for about 70 days, and then it was a smaller push-up. Similarly, you could say that, for example, this distribution period lasted about 91 days, and so what we trended down from it was, if we measure it, it was about 50% down. Now, of course, Bitcoin is very volatile, but let's see another example here. This was a big distribution period. Maybe we can consider it a distribution period, about 1 year distributing. And then the drawdown, if we take into consideration, these highs here, was about 80%. Okay, so this is very important to note. The longer an asset stays, building that cause, building that spring, as Ryan likes to say, the bigger the effect on price will be, either for accumulation or for distribution. for a trend to be built, it needs a cause, and the longer that cause spends being built, the stronger it is. Okay? Of course, depending on, as Ruben mentions here, depending on the duration and the efforts we see during the formation. Now, of course, it isn't always proportional because every single accumulation range or distribution range is built a little bit different. It has a different narrative behind it, but it is our task and our job to identify that narrative being built and to try to get ahead of it. Okay? So depending on the duration and the efforts that we see during a formation of these accumulation periods of this, cause building moment, this cause will provoke a response movement upwards or downwards. Okay, so the cause is, manipulation maneuvers, like media narratives being built, and the effect is a really impulsive movement upwards or downwards. All right. So a few elements to bear in mind is that sometimes there are certain market conditions like climactic events, catastrophes, and whatnot that can cause, like in a very short amount of time, a huge sharp turn in the asset price. Okay, and these moments are usually when the market makers, get that opportunity to, build that cause and distribute or accumulate their assets like faster and without too much preparation. So this is why I always tell people that big spikes up, if you see your favorite asset going up like 50% in a day, 20% in a day, that is almost surely at least a price to take some profits, because it does mean that some distribution is to come. Okay. Now, another aspect, as Ruben points to us here, is that not all ranges are accumulation or distribution. And this is very important. We need to be able to identify the narratives and everything that is being built behind these causes. Okay? And another thing is that the methodology, the Wyckoff methodology, tells us where the structures will be simply like price fluctuations and where they have a motivating cause that we can identify. All right, so another point that Ruben points here is using point and figure charts. Now, again, I do not want to go too much into these techniques because I feel like this is too much using past patterns to predict the future. And I don't think that is particularly useful because it is subject to a lot of personal bias. Okay. As you can watch in my, time series forecasting video, just trying to project past, patterns into the future is not particularly useful over a long enough term. Now, just to give you a small explainer of point and figure charts, I'm going to use gocharting.com. This is an alternative, charting website to TradingView. And I'm using it because it provides Renko and point and figure charts for free, and you can use split screen charts for free. And I don't use paid charting websites because I think it's not worth it. Okay, so point and figure charts are really a very similar thing to Renko charts, and the main idea here is that on the horizontal axis you don't have a fixed time frame. So in this case, like not every candle represents a day or a week. It's not a fixed time. Instead, whenever the price makes a predetermined fluctuation, then it makes a new candle, or in this case, a new X or an O. All right, this is the main idea. It can be very interesting to just watch the long-term trend. So this is the all-time history, of Bitcoin in just a small chart that you can watch. And this is, in some manner, really interesting to watch. And this is the point and figure chart. Okay, now what Wyckoff used to do is try to project like the time that it takes in each, point and figure thing, and try to project it into the future to compare it with the size of the upward trend created. All right. Now, if you want to get into it, you can pause the video and try to look at the pages. If you look enough in the internet, you will find this book for free. Okay. I'm not going to tell you why, but you can do it. And yeah, I just don't think it's particularly useful nowadays. All right, so I'm gonna skip it. And then he also does technical analysis for projecting objectives, and this includes tools like Fibonacci, Elliott waves, harmonic patterns, and whatnot. Again, I think You can use them successfully maybe, but I feel like just trying to use these fixed patterns is not a good way to, act in a market, because conditions are always changing. All right. Now the conclusion, as Ruben points to us here, is that we need some cause, we need the price to go sideways for it to go anywhere afterwards. Okay, some price, like an asset cannot keep trending forever, and it needs consolidation and accumulation periods to form a trend. All right, this is the most important thing. And when Ryan says that it would be actually beneficial for us to, head down a lot and hang down in the bear market, to just go sideways and sideways until we eventually have a parabolic run up, it is because it's true. Okay, it's true. We need an accumulation phase, a bear market, to form a cause for a new bull market. Okay, and like the Wyckoff methodology gives us excellent, like really, really good tools to understand the narratives being built, the patterns that those narratives present to us. Although I don't think that like price predictions from it is particularly useful, trying to identify, the each point of the Wyckoff distribution or accumulation can be really useful. Okay. And as Ruben concludes here, a trend will end and a cause will begin. A cause will end and a trend will begin. And the Wyckoff method, it's centered around interpreting all these conditions. So let's look at the chart again. So here's a trend, right? A big upwards trend. And then they build a cause to dump it. And then you have a small cause being built. Then you go up a little bit. And then you build that cause again for like a long, long time. And then you have a parabolic run up. And then you build another cause for it to go down, right? And it goes down. And then you build another cause for it to go up. And it goes up. And now I think we are just trending down. After, if you look at it from another perspective, you could say that maybe this whole period here was building a cause for it to go down, and maybe we go down even more and accumulate lower. But I won't predict the future in this video. So if you take just a couple things from this video, this is a little bit shorter, but I think these laws, they are a little bit more complicated, and you should watch and try to figure them out, let them rest on your head for a little bit before going to the next one. Okay, so if you only take a couple things from this video, the first one I would like suggest you to take home and like try to use it in your chart interpretation is that for every trend there is a cause. Okay, there is an accumulation, a distribution period, and for every cause there is a trend before that. Okay, so take those two things for your own analysis, for your own thesis of the market, and learn, and let's learn together the Wyckoff method for identifying these causes and these trends. All right, so this was the video for today. I hope you guys liked it, and goodbye.